my take is very clear that it's not really person to person. Okay. First, we have to go for the truth. As a scientist, there is an optimal number. Okay, and that optimal number is somewhere between 15 to 50. Okay, and these are studies done. You can do, and it's already been done. That once you go above 50 stocks, the volatility, hardly changes. And even if you have S&P 500 or you just have 50 stocks, the volatility is roughly similar. So on the risk side, you are kind of covered, right? And as you go somewhere, the lowest is 15 or 10 stocks becomes really low. So 20 to 30 is the sweet spot in our opinion. 20 to 30, maybe 40. Okay, that's the sweet spot. Below that, as you go, it starts increasing risk. Okay, and there are people, and they will quote Charlie Munger to you, right? That the Warren Buffett's partner, Charlie Munger, who Warren Buffett says is one of the smartest guys in the investment business. He says a 3-stock portfolio is sufficient, and I have only 3 stocks and stuff like that. So I've written an article on this, and the 3 stocks he has, 3 investments he has, is Costco, which is a specific company, right? A discount store, retailer. Then he has Berkshire Hathaway, which is more than probably, nearly 200 companies.
Yes,
okay?
Yes.
So Charlie Munger is being facetious when he says I have one investment. That one investment is into 200 different companies. Okay. And then he has a Lilu partnership. Lilu is one of his kind of protege, you can say, who invests in Chinese stocks using the same value investing philosophy. So again, a Lilu partnership, maybe he follows Charlie Munger, so he has a concentrated portfolio. But still, it's more than one, right? So to say that I have just 3 investments is absolutely wrong on Charlie Munger's part, and he's pulling people to do all these risky things. And we have seen what happens. So best of the best companies start facing trouble. Okay, so you have to have some diversification. And if you buy the same kind of companies, then it's not really diversification. So you need to have diversification. The traditional thing was diversify across industries and sectors. But what we propagate in scientific investing framework is diversify across growth vectors. Okay. So there are all these growth vectors like we mentioned. And for example, our IT, OmniDX, it's a growth vector which is focused on export markets, right? In US and developed markets. And it's on the transformation, digital transformation and artificial intelligence kind of work going on across all the Fortune 500 companies, right? So those are the clients for these IT companies. So that's a completely independent growth vectors from, let's say, Omni Bullet Train, which is exposing you to the metros and the bullet trains and high-speed and semi-high-speed train and freight corridors and multimodal logistics transport and stuff like that, right? Terminals. So that's a completely different kind of a growth vector. And a third growth vector is defense, where it's again completely uncorrelated to all this. So, or fourth one is capital enablers, which again is completely, capital enablers with fintech platforms and digital banking and things like that. So that is again a different growth vector, which has its own triggers, right? So uncorrelated triggers is the diversification you want. And then within each growth vector, again, you have diversification through number of companies and number of different kind of sub-industries within it. So this is the way we think about creating a supernormal portfolio.